My cell phone.
No. Hi, everybody. This is Joe from PrepAgent. How's everybody doing today? If you can hear me, give me a thumbs up, and we'll get started. Okay, so I see Diane's back. Got some new people here today. Ashley, nice to see you. And we are going to get going now. All right, so today we're going to talk about some of the financing here. Okay, first question of the day. But before we do that, remember, you guys can find me on LinkedIn. Just look up Joe Juder on LinkedIn. It's also on the Facebook group. I put a link there. So you guys can find me there. Just look up the Real Estate Exam Study group. I put a link there. So go through there. You can find me. And as always, join that Facebook group so you can talk to other people just like you. That being said, which of the following is true of a second mortgage? A, it is usually at a higher interest rate. B, it cannot be used as a security instrument. C, it has priority over first mortgage. Or D, it is not negotiable. Okay, and the answer is A. Your interest rate is related to risk. It's all about risk. Okay, the more risk you are, the higher the interest rate. Why is the second mortgage at a higher interest rate? Why is it more risk than the first one? Who knows? Why is that more risk? Okay, it's because the second mortgage doesn't get a nickel until the first is totally paid off if you run out of money. Okay, so therefore it is more risk, and therefore it is that highest interest rate, that higher interest rate, excuse me. What clause is used when you want the second mortgage to take priority over the first? What do you guys think? What clause would you use? Okay, I see subordination clause. The correct answer is subordination clause. Subordination clause is the clause that is used so the second mortgage could take priority over the first. Good job, guys. The purpose of a release clause in a mortgage is to A, allow the release of some properties upon partial payment when more than one property is used as security for the debt. B, release the title company from liability. C, release the lender from liability. Or D, allow the borrower to be released from liability. What do you guys think? I see some A's. I see some B's here. Mostly A's. So therefore, we're going to go with A, and the answer is A. Okay, it allows the release of some properties upon partial payments when more than one property is used as security for the debt. So my follow-up question is, what kind of mortgage would you use when you want to borrow against more than one property? What kind of mortgage would you use if you want to borrow against more than one type of property? Can the answer be blanket mortgage? Could you either studied really hard, know your stuff, or you just read the explanation below? Either way, you got it right. It's good stuff. Okay, a blanket mortgage is when you get a mortgage to borrow against more than one property. Okay, moving right along. A balloon loan could also be described as A, non-assumable loan, B, partially amortized loan, C, due on sale loan, or D, fully amortized loan. Okay, I see a lot of B's. I see one C. Oh, I see a D. But the answer would be B. Okay, a partially amortized loan. All right, so this word amortization comes up. What is an amortization table? Who knows what that is? Who here could tell me what is an amortization table? Who knows that answer? What is an amortization table? Amortization table. Okay, so what an amortization table does is charts that monthly payments. The key word there is monthly. You guys got to remember that. Monthly payments. Everybody write monthly payments. I want to see this chat room bling, bling, bling with the word monthly payments. Okay, everybody write monthly payments. Because that's the key word. It's going to help you remember. So I see a lot of people writing that. Thanks, guys. You're a good group. Okay, so you got your fully amortized loans. That's something that's paid off all the way. Okay. You have your partially amortized loan, which means it's getting paid off, but before it's fully paid off, you make one big payment known as this balloon loan. Okay, so it's partially amortized. My next question is, what would be negative amortization? Who knows what that is? Who knows what negative amortization is? Negative amortization. Negative amortization. What do you guys think? Negative amortization. Okay, so I saw Deanna wrote no interest paid. So you could pay some interest, but you're not paying all the interest. So that means your debt goes up. Your debt goes up. Okay. So negative amortization means you're not paying all the interest. So for example, if I lend you $10 at $1 interest a month and you only pay me 50 cents a month, your debt keeps going up. Okay. Following up on that line of thought, what is a straight note? Who could tell me what a straight note is? Can anybody do that? A straight note. Okay, interest only. So that means your debt stays even month after month. It's a straight note. Okay. I suppose negative, your debt goes up. With a fully amortized loan, your debt goes down. All right. Good job, everybody. When the general level of prices decreases, A, the value of money decreases. B, it has no effect on the value of money. C, the value of money increases. And D, the value of commodities increases. The answer here is C. Not much explaining here right now. Okay. If an apple's worth $1 and you have $1, you can buy one apple. If the price of the apple goes down to 50 cents, you could buy two apples. Your money's worth more. It's a reason your mother always explained things by saying apples and oranges. Something about that just makes everything so clear. When a lender speaks of discounting, the lender is probably referring to A, the loan proceeds dispersed by the lender are less than the face value of the note. B, the difference between the nominal interest rate and the effective interest rate on a specific loan. C, the process of determining the effective interest rate. Or D, the process of determining the actual yield of a given loan by adjusting the variable interest rate. Okay. See some B's, I see D's. All right. It's the loan proceeds dispersed by the lender, the face value of the note. We're going to go over that one again. There's a lot of people put a lot of different answers there. We went with D, as the majority of you guys circled D, but the answer is A. Okay. So in discounting, all right, they're just dispersing the amount of the loan by making it less. Okay. We're going to talk about that again in a little bit, so don't worry about it. Remember, whenever we get one wrong, it goes into the right-hand column. Carol made an offer to purchase Greg's property. As part of the offer, Carol agreed to take title subject to an existing loan, which Greg obtained when they purchased the property in the approximate amount of $39,000. If Greg sells to Carol under these conditions, which of these following is true concerning liability for a loss suffered by the government after a foreclosure on the VA loan? A, neither person is liable because Carol took title subject to the existing loan. B, Greg and Carol will equally be liable. C, Carol will be primarily liable. Or D, Greg will be primarily liable. Anybody know where Carol and Greg live where they could buy a home for $39,000? I think I need to update that question. And you guys live anywhere where you could buy a home for $39,000? Okay, a lot of you guys got the answer here. Yeah, Oklahoma. And the answer here is D. Good. What we're talking about is the difference between assume and subject to. Who here knows the difference between assume and subject to? Subject to and assume, what's the difference? What do you guys think? So the big thing they're talking about here in this question, right there, that subject to word. What's the difference? What do you guys think? Assume and subject to. Okay, assume is when you're taking over responsibility. Subject to, the buyer's taking it subject to the seller paying it off. So I want you guys to remember this, okay? And I want you to write this down. Assume buyer liable, subject to seller liable, okay? Assume buyer liable, subject to seller liable, okay? And that is correct. To do it assume, the lender has to approve the loan because the buyer's taking over the loan, so they have to approve of who's taking it over. But in the meantime, so we all remember for our state exam, write that down. Assume buyer liable, subject to seller liable. Okay? Remember, we always want to narrow it down to these simple words. Okay, moving right along. The open-end clause in the mortgage would benefit the borrower the most if he A, prepaid the loan, B, allowed a subsequent buyer to assume the loan, C, had a loan subordinate to a construction loan, or D, borrowed additional money. Okay, and the answer there is D. Very simply said, this is like a credit card. Okay, open-end mortgage, open-end clause just means you could borrow more against it. It's open. Okay, it's like having an open tab at the bar. For those guys who go to bars, not all of us do. Okay, so borrow additional money. And in case I forgot, as you guys know, I'm speaking here, but I have my friend and partner in crime here. Arthur is running the chat. So if you've got any questions, he will write you there. So I always like to let you know that he's present. So Arthur running the chat. I'm on here. Everybody say hi, Arthur, if you don't mind, so he feels welcome. And we'll move on. Okay, move right along. Okay, when a lender speaks of discounting, the lender is probably referring to A, the process of determining the effective interest rate. B, the loan proceeds dispersed by the lender are less than the face value of the note. C, the difference between the nominal interest rate and the effective interest rate on a specific loan. Or D, the process of determining the actual yield of a given loan by adjusting the variable interest rate. Okay, we did this one before. We all got it right now. And we're moving right along. Okay, where's everybody from? Really quick, write the state you're from while I go to the next question. I want to see where everybody's from. Let's see how across the country we really are here. California, Texas, Colorado, California. Oh, we got a big Cali contingency today. Hey, here we go. The type of mortgage loan which permits borrowing additional funds at a later date is called A, an open mortgage, B, a junior mortgage, C, an extendable mortgage, or D, an equitable mortgage. Okay, we went over this before in a different question, but asked about the same concept. And the answer is A, open mortgage. Okay, good job, everybody. I see this word equitable down below. That's a really important word for your state exam. What is it when you have equity? What does equity mean? Let's start with that. What does equity mean? Equity. What is equity? Who could write to me and tell me what equity is? Okay, I'm going to give you the stuffy real estate exam definition. Equity is your interest in the property above and beyond all liens against it. Nice job, Jenny in Colorado. That was a great way to say it. Value minus liens. Your interest in the property above and beyond all liens against it. Okay, what is a lien? What is a lien? Who knows what a lien is? A lien is when you owe money. A lien is when you owe money, okay? So I often like to say equity is when you sell your house after you pay everything off and what goes in your pocket and you go buy a cookie with. That's what equity is. Okay, so now we know what equity is. What is equitable title? What is equitable title? Who could tell me what equitable title is? Equitable title. Cookies are great. I agree, Angelica. Okay, equitable title. That is the right to use and possess and to gain equity. Okay, so when you have equitable title, you have the right to use and possess, and that equity is yours. Hence, equitable title. Okay. Now, if you don't have equitable title, the other type of title that's discussed in that scenario is legal title. What is legal title? Who could tell me what is legal title? Okay, legal title is the right to sell. Good. Equitable title is the right to use and possess. Legal title is the right to sell. Okay. Very often the bank or the trustee, depending what state you're in, would have that legal title. That's the right to sell it. Okay. And after you pay off your loan, they reconvey title back to you in a reconveyance deed. And then you have both. But until you pay everything off, you only have equitable title. Okay, moving right along. When considering portfolio risk management, the lender needs to be concerned with which of the following: A, reserves; B, reserves diversification and liquidity; C, diversification; or C, liquidity. What do you guys think? And the answer is B. Good job, everybody. The measures of goods and service produced by the nation during any one calendar year is called A, gross national product; B, cost of living index; C, national economic cycle; or D, national income. And the answer is A. I got a big trip coming up soon. Can anybody recommend any good movies I should rent for the trip? What do you guys think? Anybody? Anything? Movie recommendations? Would love some. But while you guys thinking of that, we're going to go to the next question. When the real estate market changes from a buyer's market to a seller's market, which of the following results could naturally be expected? A, prices would rise because of the increased demand and lacking supply. B, prices would be unaffected since every parcel is unique. C, construction activity in a new subdivision would decline. D, prices would probably drop because of the increased supply and reduced demand. Melissa McCarthy is funny. I agree, Jessica. Okay. And the answer is A. Good. Prices would rise because of the increase in demand. It's the old rule, supply and demand. Okay, nice job. Who here could tell me what is the FHA? What does the FHA do? Who knows? Let me see if any of you guys know. What is the FHA? What is the FHA? FHA insures loans. Okay, you do not get a loan from the FHA. When you get an FHA loan, do you need a down payment? Who knows? When you get an FHA loan, do you need a down payment? Jessica says yes. Good. What type of loan do you not need a down payment for? Who knows? Which one do you not need a down payment? VA is the one where no down payment is needed. VA. Okay, good job, guys. A takeout loan in real estate financing is A, a short-term loan generally to finance construction. B, a long-term loan to replace a construction loan. C, the amount of net proceeds actually available to the borrower after the deduction of a discount point and prepaid interest. Or D, a loan that calls for your payments to be made on intervals. And the answer is B. Nice job, guys. Okay, so you have this takeout loan and interim loan thing that comes up. Okay, a takeout loan is a long-term loan. An interim loan is a short-term loan. The interim loan is for while the construction is being done, and then it converts to a takeout loan after that its process is over. Okay, Jessica, I'm not sure of that. We'd have to look that up for you about the USDA. Yep, Shaniqua, takeout loan, long-term loan, interim loan, short-term loan. The term warehousing as used in real estate financing means A, the financing of industrial warehouses, B, a mortgage company collecting loans prior to resale, C, unregulated real estate loans, D, a large bank or savings and loan. And the answer is B. Where do they sell these loans? Who can tell me where they sell these loans? Where are these loans? Secondary market. Good. Secondary market is what I was looking for. What is the secondary mortgage market? Who knows? Who here could tell me what is the secondary mortgage market? Secondary mortgage market. What's that all about? Anybody? 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 So Fannie Mae functions there, but it doesn't give you the definition. Angelica Diaz nailed it with the resale loans. It's the resale marketplace. Remember, resale marketplace. Everybody write down resale marketplace. Okay, resale marketplace. I want everybody to write that down. Resale marketplace. Okay, moving right along. When obtaining a mortgage loan, the buyer often has to pay discount points. Those points are a percentage of A, the selling price minus the agent's commission, B, the loan amount plus the closing costs, C, the selling price of the property, D, the loan amount. And the answer is D, the loan amount. Good, it's a percentage of the loan amount. Nice job. Okay, next one. The annual percentage rate, APR, is defined by the federal truth in lending laws as A, relative cost of credit expressed in percentage terms, B, the total of only the indirect cost of credit which the borrower must pay, C, total of all costs which the borrower must pay to get the loan, or D, the total of only the direct costs of credit paid by the borrower. Jessica Clark, do not worry about asking questions. Ask as many as you want. I just saw yours. The questions can be similar, or sometimes they may not be, but what is true is the concepts we want you guys to learn. Okay, we do try as hard as we can to make this similar. We can't have the exact questions to your exam, because if we had that, we'd go to jail. That'd be illegal. But the big point of this is to know the concepts. That's why I always say don't memorize these questions. And that's also why we randomize all the questions in our system. We randomize the order of the questions, and we randomize the way the answers are given for every question. And that we do that to prevent memorization of the questions, because we don't want people memorizing it and just getting 100% all this and not understanding the concepts. Okay, and the answer to this one, the annual percentage rate, APR, is defined by federal truth in lending laws as relative cost of credit and expressed in percentage terms. Okay, let's see who's been watching my webinars. When you start studying, what should you start with? Where should you guys begin your studying? What do I always say to everybody? What is the foundation of studying for the real estate exam? Let's see who's been following me. Nice job, Jimmy. Jimmy wrote vocab. Vocabulary, vocabulary, vocabulary. This is nothing more than a glorified vocab quiz. Okay, for example, I'm looking at this one. If you study your vocab, what APR is, this would be one right on your exam. Hey, always know your vocab before you start doing the questions. Do not do any questions if you don't have your vocab nailed down. If you do that, it'll just be an exercise in frustration. It's a process with everything. When purchasing with FHA financing, a new buyer would normally do each of the following except A, apply directly to a bank or savings and loan. B, pay for a mortgage insurance protection. C, buy a home which confirms with FHA requirements and restrictions. D, apply to a local FHA office for the FHA appraisal. And the answer is D. Jessica asked me, do you recommend the crash course 2 days before a test? Unfortunately, it's not that simple. It depends. It depends how good your attention span is. It depends what the teacher is doing, and it depends the material they're sharing. A lot of people ask me about crash courses. Let's understand what those are. Those are sitting in a room for 1 full day or 2 days with people lecturing about real estate law. Most of us zone out on those type of classes, but if you're able to stay focused, go ahead, rock out. The other problem, there's a lot of teachers who tend to go off on these huge tangents, okay? And they tend to go off and start talking about the real estate industry and what they did in real estate and how great they are and all that kind of stuff. When the reality is, you don't really care about practicing real estate at that moment. You just want to pass your test. You want to hear all that stuff after you pass your test. So regarding those crash courses, it's just not that simple. You got to do a little research to what works for you and what they're doing. Okay. So Regulation Z, come back tomorrow. I see that request, so I'm going to prepare something for Regulation Z tomorrow. So I see 2 people requested that, so I'm going to prepare something nice for you guys about Regulation Z. Okay, so we'll have a nice little lesson. So how's that sound? We'll open up about Regulation Z, because I don't think I have questions on that right now, so I want to prepare something. Okay, here we go. When processing a real estate loan application, a lender would correlate characteristics of a borrower, loan, and property to make A, a credit rating, B, a property appraisal, C, a liability statement, D, a loan commitment. And the answer is D, a loan commitment. Good. When the amortized payment of a mortgage remains constant over the period of the loan, but leaves out an outstanding balance to be paid at the end, this payment is called A, a satisfaction payment, B, a balloon payment, C, an escalation payment, or D, an acceleration payment. think we went over this concept before in a different form. And the answer is B, a balloon payment. The discount points charged by a lender on a federal VA or FHA loan are a percentage of the A, down payment, B, loan amount, C, appraised price, D, sales price. And the answer is B, loan amount. I see Shaniqua saying finance is so hard. It's hard for me too. I always hated it, but you get through it. And also remember, if this is hard for you, but you do well in the other sections, you're going to pass. You don't need to get 100% to get your real estate license. After you pass, nobody's going to care if you got the worst passing score on the real estate exam. They're just going to know that you got a license. This is all going to be a thing of the past after you guys get past this exam. When loaning money to two or more co-borrowers on a single promissory note, the lender would be best advised to increase the security in the note by inserting which of the following phrases after the names of the co-borrowers? A, personally and corporately, B, jointly and severally, C, individually and severally, D, together as individuals. Okay, and you see jointly and severally, people are together. Good. The Federal Reserve Board increases cash reserve requirements to A, raise taxes, B, increase loan activity, C, sell bonds, D, increase loan activity. Okay, and the answer is B, decrease loan activity. They're reserving money, they're holding it back so that there's less money going out. All right. Okay, there you go. So that's that for today, guys. And tomorrow we'll be picking up again, same time. It's good to see everybody. And if you have any things you want me to go over, like I saw somebody mention Regulation Z, I think that was Jonia, said Regulation Z, put it in that Facebook group and you could, and I'll look it up there. You could also write me a message through Facebook, and that could be a great way for me to get the message as well. And then we'll be good to go. Jessica said, did you change it from 8 a.m. to 2 p.m.? I will check the schedule on that, and I will get back to you, and I'll post it on the group. Yeah, other than that, thanks, guys. I hope you guys have a great day. My name on LinkedIn, here, I'll type it here, Joe Juder. Okay, just type that there. So just look me on LinkedIn right there. So it'll be linkedin.com/Joe Juder. I would love for all you guys to connect with me so we could build our network and grow together as we all try to be successful. Hey, guys, see you tomorrow. Talk to you soon.